Hi guys, my name is Phil Gunst, and as you can see from my bio here on YouTube, I'm a 23-year-old Dane, and I am crazy about investing and the stock market. So first of all, I've actually created this YouTube channel for the sake of my Twitter. So first of all, I think there may not be any context whatsoever about the videos I post here on YouTube. That being said, I never imagined I would create a YouTube channel. I think it's actually quite insane, and I think I never imagined I would end out here. No offense to all of you YouTubers. However, I think let's start off with a bit of background about myself. So as I mentioned, I'm 23-year-old, and I'm from Denmark. I am working as a strategy and management consultant as my day job. That being said, I've been investing in stocks for the last 5 or 6 years. Joined the stock market back in 2015 as a young fella, and my passion from investing comes from my granddad, who has taught me about the stock market since I was a little guy, and visited him in his summer house every summer, and I watched text TV and saw page 852 on Danish national TV being an overview of the C20 back then, the C20 index, the Danish primary stock index. And since then I've been passionate about it, and I think that also sort of created the path for where I ended up now. I have a background from international business on CBS, where I have my bachelor degree, and I think when I joined IB, I was quite certain that I wanted to become an investment banker and become the next Jordan Belfort. However, throughout my 3 years at IB, I figured out that the culture on Wall Street, both in New York and also in London, is quite toxic, and I sort of figured out that I didn't want to be part of that environment, but I never really left the stock market. Back in 2018, I joined the national radio program called Millionærklubben in Denmark, which is listened to by approximately 500,000 Danes on a monthly basis. It's no longer a radio program, now it's just a podcast, and I'm still joining the program as an expert every now and then. I'm no expert whatsoever, I'm only a young guy that's extremely passionate, and I found my edge in fundamental analysis. So what I basically do is that I apply what I also do in my day job as a consultant, doing a lot of due diligence on the stocks I invest in. Often I do loads of due diligence prior to actually entering a company, and I love doing due diligence. And I've been hurt significantly also return-wise on a few a few companies I've invested in, and that has sort of built the ground for actually being quite thorough. And I think the stock market today is in a craze. We're at all-time high levels, and I think it also has brought in a lot of people to the stock market that is not necessarily investing for the sake of growing their money over time. We know that the sort of classical theory of the stock market is growing approximately 7% a year over time. It has done that for the last 200 years or so. But because of the fact that it has been possible to create significant and enormous returns over the course of the last 10 years of this bull cycle we're in currently, since the financial crisis back in 27, 28, there are lots of people on the stock market that is trying to earn money quite fast, and by that they're also following people like myself and just following them blindly. However, I've always been passionate about learning people about investing and sort of saving. I've been doing loads of talks in schools, and also my rationale for joining Millionærklubben back then was actually to learn people like you guys about how you're doing thorough DD and sort of building yourself the best possible foundation for becoming successful in the stock market. And I think there are loads of people that are doing technical analysis. That's fine. It's not really my turf. I've applied it sort of how can you say it, in a sort of a complementary way to my fundamental analysis in the last 6 months or so, and I'm going to talk a bit about that today. However, there are lots of investors that are solely investing based on technical analysis, and then I'm on the other side of the line, sort of doing fundamental analysis, basically deep diving in a company. What is the competition? What are the entry barriers in terms of competition? What are the financials? How competent is the management? What is the capital structure? What is the edge of the company? How strong is the product or the project? By how big a CAGR is the market growing annually? How much is the company going to grow? How scalable is the company? So on and so forth. These are some of the aspects and elements I'm looking into when I'm analyzing a company. And you can find loads of threads on my Twitter profile, which can be found in my bio as well, link to that, about how I actually approach my due diligence prior to entering a stock. That being said, I think that was a bit of a background to myself as an investor and also as a person, and why I'm actually doing this, and why you should join my journey as an investor. Not necessarily for the sake of me and my returns. That's all good. That's for my own sake that I'm investing. That being said, I wanna fill your baggage and your luggage with loads of tools and insight, transparency. And I think that is what is missing out there. Transparency is a huge gap in the stock market, especially on social media. How do you actually become successful? And I don't say I'm successful. However, if I'm not successful, I want to bring you in and sort of put the loop on and understand what I did wrong in specific investments and why it went wrong. So let's begin the journey together. And I think I've brought a couple of topics today, and I think this video may be longer than my videos will probably usually be. However, I want to talk about a couple of things. So let's just go through the agenda. So first of all, I want to talk a little bit about the markets. We had a red market today. In the US, only by small margins, small percentages. That being said, I want to talk a little bit about the weights of specific companies in indices and how it affects the overall development of the markets, looking a bit back into the last 12 months. That's one. Two, I want to talk a little bit about psychological bias. I've studied markets for the last 6 years quite intensely, and I think the psychological aspects of the market is extremely interesting. And I think all of the mistakes typical investors are doing is because of psychology and sort of emotions and being affected and influenced by your emotions. And I'm going to talk a little bit about that, looking into the last 12 months and this insane year we've had on the stock market for the last 12 months. And then finally, I'm going to talk about what I introduced just previously about the difference between technical analysis and fundamental analysis, and why, even though I'm not a technical analyst and not a guru regarding technical analysis, not following specifics, I'm sort of a bit picky, but apply those few tools to my investing style and sort of trying to time entries a bit better, as well as understand the trends in specific stocks regarding that. So that is what we're going to look into today. Let's start off with the first one. So we had a red day in the market today. Several of my stocks are down between 3 and 6%, even 3 and 10%. I'm quite heavy, or not heavy, but I'm in several SPACs. These blank check companies that have been a huge trend in 2020. So SPACs are basically blank checks, capital funds that are buying or IPOing with a blank check, no company, only the fund that I invested into that company, and then they are IPOing other companies in a bit easier way than if you should go public in a regular way as a company. Several of these SPACs are down 5-10% today, and they sort of dropped immensely quite early in the day, and I on my Twitter I tweeted a few of these adding zones that I like to call them, where whenever I see a good opportunity in the market in the positions I am in, I like to tweet about them, adding, sort of telling people where I see a good adding position. Sometimes I think maybe 2 out of 10, maybe 1 out of 10, it's too early. So the adding zone is actually too early in terms of the trend it's in. However, I would say 8 or 9 times out of 10, I'm actually quite good at finding the bottom and sort of stocks are rebounding afterwards. So if you're able to actually find my adding zone tweets, then you have a good opportunity and possibility of actually creating a quite quick return on that adding to your portfolio or your existing position. A good example is Good Food, a company of mine in my portfolio that I actually sold a bit off today. However, I posted an adding zones tweet, I think it's 3 or 4 weeks back now, at $8 Canadian, and today I sold 25% of my position at 11.80. So that is just a quick comment on these. However, back to where we came from. So the market is down 0.2, 0.3% if you're looking at SP 500 and Dow Jones. However, Nasdaq, I think, was down approximately the same. Russell 2000, the small cap index of the US, however, is down 2%. Quite a big margin between the major indices and the small cap index, and also the small cap is probably also where you'll find some of these SPACs. So back to the big difference here, and the cause of that big difference is that when you have these major indices, they are filled with, so S&P 500 is of course filled with 500 companies. However, the weight of these different companies are completely different based on their valuation and the market cap. So a good example are the FAANG stocks. So we have Facebook, we have Alphabet, we have Netflix, we have Google, we have Amazon, we have Apple, we have Tesla. We have some of these major companies that have developed over the course of the last bull cycle of 10 years into enormous companies based on valuation, also relative to companies in the bottom of the S&P 500. That means that when you look at the weight of these companies relative to what I will call the other ones, it's enormous and it's significant. I read an article stating that whenever Microsoft or Apple or Amazon or Alphabet, Netflix, one of these, Tesla even, has become a huge company, whenever they individually is increasing 5%, let's leave all of the remaining 495 companies out of this equation. Whenever one of these companies are up by 5%, the S&P 500 is going up by 0.5 percentage points. That means that whatever happens to the remaining 495 companies, you can have S&P 500 up by 2.5% only based on those. And then of course, if the remaining 495 companies are down by several percentages, then that will sort of drag down the overall development of the S&P 500. A good example today is that we have Amazon being up, I think it's 2 or 3%. However, S&P 500 is down 0.3%. There are loads of the other companies that are red. If you sort of find that blueprint of all the S&P 500 companies, you'll find that the majority of them are red today. It has been a difficult market to move in today. So that being said, you need to understand and sort of have that knowledge in mind whenever you're looking at the overall futures, and especially in the US, that a few companies, a few stocks are really influencing the picture and sort of changing the picture for the better or the worse to a significant extent. Also looking back at how the markets have performed over the course of the last 12 months. S&P 500 is up approximately 17 or 18% on the year. Quite good for a year where we have been sort of affected by COVID and sort of that mess throughout the year. Nasdaq is up approximately 40% on the year, insane year for tech and growth stocks. However, looking into the development of an S&P 500 and Dow Jones, you'll find that the tech stocks that are implemented and infused into the S&P 500 index will come from the Nasdaq stocks. So basically, if you were sort of withdrawing those tech stocks from the S&P 500, you will have a significantly worse return on the year. Have that in mind and sort of let that sink in. It's quite insane, and it will likely change your perspective on the stock market, and especially the American indices. Taking from the first agenda point today, moving over to the second one, I think now you had an intro to how the American indices have performed over the course of the last 12 months. I think the second thing I want to touch upon today is psychological bias. And I think it's no public secret that I have been managing my family's portfolio for the last years. And looking at the curve of 2020 for the stock market, you'll see it go quite a bit up, a heavy drop, and then surge throughout the year. And we have had an amazing year since the bottoms around 18th of March. And I think around the 20th or 21st of March, my dad called me and he was fearful as hell. His voice was a bit shaky. My parents had to have cash out of the portfolio within the next 12 months. So he was quite fearful in terms of how the portfolio has developed. And just to give you a bit of context, the portfolio was down 40% within 1 month. Looking back into March, it's the most insane period I've seen on the stock market in my 5 or 6 years. So I've experienced a couple of downturns in 2017, I think it is 2016, when we had the oil prices down in $20 per barrel. Also with uncertainties in China regarding the economic outlook, where people thought that the economic growth in China was stagnated. So we have had some rough periods where the market has corrected, I would say 15, 20, 25% throughout the last 6 years. However, the 50% drop in the markets, I think DAX, the German index, leading German index, was down 30, 35, 40% over the course of only a month or so. And the markets, the indices, fell by 10, 12% a day. It was insane to look at, and I think my brain just sort of switched off. I saw that the markets were irrational, and it was just fear. And I think a great piece of the puzzle here is also that a greater share of the market today are driven by algorithms, and algorithms are of course trading based on signals and specific signals, specific codings. And when stock markets are developing as they were back in March, things are just escalating significantly. So what I told my dad in the phone the 20th or 21st of March was that be patient. What I've learned over the course of the year is that whenever you are seeing those graphs of the market and sort of those cycles and how they're going, and sort of connecting those to specific feelings, is that, for instance, where we are now, all-time highs, market has been through an amazing development over the course of the last 8-9 months. The overall economy is not doing very well. However, the stock market has just blown off over the course of the last 8 or 9 months. So we are in a euphoria state right now. As I've also said in one of my threads on Twitter, I think we can go on into 2021 with economic stimulus from the central banks, and also interest rates around zero. I see several positive catalysts going into 2021 with the vaccines being rolled out now, and I think we'll have a fine 2021. Not as good as 2020. However, we are in a euphoria state right now. People are joining the stock market all over the world. We have loads of these Robin Hooders that are posting on Twitter. Everybody needs to own stocks right now because it's a no-brainer. And I think that is where things get toxic, and that is where you should focus on risk managing. It's extremely important in these periods to risk manage your portfolio. Take profits home whenever you get them. So if you have a stock that is up 50% within a week, take profits home. You don't have to sell everything. I do that all the time. I sell, as I did with Good Food today, I sold 25% of my overall position. However, please take profits home whenever they're there. That's one. And two, don't go all in for instance, in high risk stocks. Myself, I'm in junior minors, which is of course a high risk. It's a little bit like biotech. When you're drilling and in exploration companies, it's either hit or it's dusters. And of course, the stock market will develop based on whether you give them hits or dusters. So an easy 20-25% drop if you get dusters. However, SK Mining from Canada up 100% in 2 trading days if you get a good hit. So huge risk. However, do a lot of DD. So I think even though my Sharpe ratio would be throughout the roof, I think I'm actually at a good level, and I don't have all of my capital in these stocks. Okay, so that's one. However, looking back to March, there are loads of people that probably sold all of their liquidity in the stock market and left the stock market in March. I know loads of people, colleagues, economists, really clever people that have been on the sidelines since March and just been thinking, I don't want to buy into the stock market right now. I don't want to be here with this COVID going on and this uncertainty. So they have been on the sidelines since March and just been waiting for a good opportunity to buy, but it just never came. So I think that there's people that are leaving the stock markets on the bottom where it's just capitulation. People don't want to be there anymore. Back to 27, 28 in the financial crisis, loads of people lost 60-80% of their capital based on the drops in the stock market back then, and then they left and they have never sort of gained their money back. However, if they were in the stock market and just left their capital in the same stocks they owned prior to the crisis, 12-18 months after, they would be at the same level as prior to the crisis. So there are definitely some psychological aspects into this. I could talk loads and hours of psychology regarding the stock market, and I've been doing so on public talks at schools and stuff like that for years. But I don't want to spend too much time on that in this first video. I think the last thing I want to touch upon in this video, I'm already 22 minutes in, so time is flying, is about technical analysis and sort of how I apply that to my fundamental analysis. So technical analysis is basically looking at the graphs and the lines in a stock chart, and based on those different parameters, different metrics, you're deciding whether a stock is a buy or a sell. I think it is a bit overestimated or overvalued, so to say, in terms of what is actually rational and actually not rational. So based on lines, you are able to say whether a stock is a buy or not. Doesn't seem logical based on all of the complexities that is behind a company that is listed on a public exchange. That being said, we have thousands and thousands of traders out there that have been earning money on doing technical analysis in the stock market for the last many years, and I think it has become a sort of a common part or puzzle of the market. And I think why it also is going so well for many technical traders, there are also loads of them that are not earning any money or returning anything at all on it. However, why I believe that some of it is actually going quite well is also because if you have loads of people that are reacting to the same parameters and the same signals in the market and the same patterns, then of course it will end up becoming real. So that's also why I think some of these technicalities that you can look into are quite interesting, and I like to add it to my fundamental analysis, especially for entry strategies and timing the market. A common phrase in the stock market is that you can't time the bottom and you can't time the top, and that's correctly that's true. And you shouldn't strive for that. However, if you can get as close as possible to the top and as close as possible to the bottom, then you're quite good. And I think technical analysis are able to help you do that. Second of all, I think it's a quite good pattern or tool, at least, to help you indicate a trend based in individual stocks. So I'll just give a few tools to you. Have a look at them. I don't want to spend too much time deep diving into to sort of the background of these tools, but I'll give them to you, and then you can sort of bring them back home and try and play a little bit with it. So the first one I like to use is Fibonacci levels. So Fibonacci levels is quite good for indicating when to buy a company in a turnaround situation. So when are stocks churning? So basically, if you've had a stock like Fubo TV, which has been an absolute rocket for the last 2 months, up from approximately $10 to $62, I think it topped out as, and now it's down to 40. I think that is a perfect example of when to use Fibonacci levels, because a good example, I think often you say that there are some specific levels. I'm not into it by heart, so you can look it up yourself. And then if they reach these levels, there are several levels of these that are more frequent in terms of churning than others. And I think it's quite good for finding these bottom out plays when they have been churning 20-30% from the top. Then you're able to see where to buy, and you're quite good. You're quite safe when you're buying at these levels, at least from an overall perspective. So that is one. Then there are some classical sort of trend lines. I like to look at pivots, and pivots are basically previous highs and previous lows of a stock. So basically, whenever a stock is creating a new high and a new low, then you have pivots. So I love to look at these, especially in terms of looking at the trend of a company. So a good example is Cabral Gold, my primary position in my long-term portfolio. Cabral have been quite bumpy throughout the year, so it went from approximately 10 Canadian cents per share up to 88 cents, and then back to 45 cents. And we have had some pivot points, and you can basically take up the chart and then you can see them as well. So recently, I think it was last week, we broke out of previous resistance being 66 cents. And a classical example of that is that you often want to retest that breakout point or breakout level, so to say, resistance level. And last week it sort of retested that. So I think 2 weeks ago or so we broke above 60 cents again, which has been quite some resistance. And then 66 cents was a tough resistance from previous highs back in the fall. And then we went to, I think it was 74 cents a share in the early last week, and then around Christmas Eve we bottomed out around 60 cents share, 66 cents per share. Wow, that was difficult to say. So back testing this resistance level, and today we sort of broke out again, up 10%, and I think we closed around 74-75 cents per share, which is extremely strong. And now we're looking at previous all-time highs, probably 0.8 as the first resistance and pivot point, and then 0.88 all-time high being the next resistance, which will likely be a bit tougher to break through. So pivot points are an extremely good tool, technical analysis tool to use for these trend indications. Another good tool for that is RSI 14, which is sort of indicating whether or not a stock is in an uptrend or a downtrend. So basically RSI 14 is a 0 to 100 metric, and between, I think it's 30 and 60, you're sort of in a medium neutral environment. You can be in the upper percentile of that band, and then you're in a small uptrend, and you can be in the lower, and then you're in a small downtrend. However, if you get below 30 or above 60, you're either in a heavy uptrend with lots of momentum, or you're either in a heavy downtrend with lots of negative momentum. And I think it's in a short period of time. I think it's 14 days based on the 14. So basically it shows you a short-term trend of the stock. And basically, often if you're getting above 60, you have some momentum upwards that may fuel some additional upside, as well as the other way around in the bottom below 30, right? So that's a great tool as well. And then I think the last tool I also like, and that is more for swing trades and sort of indicating longer term trends, is looking at SMA 20 and SMA 50. And when you get the SMA 20 above the SMA 20, basically the moving average for 20 days and moving average for 50 days, when the short term moving average, so the 20-day moving average, turns above the 50, so if you have the two lines on your chart, then basically when the 20 and the 50-day intersects with the 20-day going above the 50-day, that is a very positive indicator for a change in the long-term trend. So that is also an indicator and a tool you can have a look at yourself. So these are some of the technical analysis tools I like to use when I'm doing my fundamental analysis, and also when I'm in positions in terms of indicating whether or not we can have an outlook into some great momentum in stocks or either the opposite. So I spent quite some time on this video. It's the first one on my on my YouTube. However, have a look at my Twitter as well. My name is Philip Gunst in there. It's quite difficult to spell. Everybody gets it wrong, at least the first one. But it's a PHILIP and then Gunst, GUNST. And you can find me as well via a link in my YouTube bio for my Twitter. And then keep you posted. I'll likely do some videos every now and again. I already have a request for giving my followers on Twitter an insight into what are the tools that I like to use whenever I'm doing fundamental analysis, and I'll get back to that. But until next time, thank you so much for listening in, and I hope this was all right. I don't want to spend too much time in terms of setting things up, so I'm not gonna optimize my setup in terms of sound or video, at least not for now, as well as I'm not gonna put charge in my videos for now. You can do that by yourself. So I just want to do some voiceover to some of the topics I'm touching upon on my Twitter, and I hope that is all right. But keep yourself posted, and then I'll talk to you soon again. See you. Bye.